Good morning, friends. This is class number 19. No? Class number 19 on accounting. The topic today is statement of affairs vis-a-vis balance sheet, arrangement and marshalling. So that is the topic. I told you yesterday that today's topic will be marshalling of balance sheet. Marshalling of balance sheet. Now, first of all, before going for marshalling, I would like to clear the term balance sheet in detail. I would like to clear the term balance sheet in detail. What is balance sheet? And if you see what you have done so far, balance sheet is a statement having two sides. In the right hand side, we write assets and properties, and the left hand side we write capital and liabilities. So it is in a nutshell, it is a statement of assets and liabilities of any economic entity or any accounting entity at a particular point of time. Mind it, it's a particular point of time. When we prepare it, we prepare first of all, go back a bit. Our accounting process has revealed that it has got a good number of functions: occurrence of the transaction, the occurrence of any event, identification of the transaction, the debiting and crediting, then comes recording, primary recording, then posting, costing and balancing in ledger, then summarizing. In summarizing, what we get? In summarizing, we get all the ledger balances, and we segregate the balances into two parts. One is debit balance and the other one is credit balance. And both the sides, both the balances are equal. And it is known as trial balance, and this trial balance, if it is agreed, it assures us that our accounting activities are correct so far as arithmetical issues are concerned. So arithmetically it is correct. Now, trial balance is a statement of all the assets and the liabilities, all the expenses and the incomes, the debtors and the creditors and all this, all losses and gains. So it is a summarized statement. With the help of this summarized statement, the items included over there, we go on preparing two statements. What is the statement? One is the statement of profit or loss. Why? Because our ultimate objective of accounting is the business is meant for profit. Transaction is meant for business. Transactions are recorded through accounts. Account is meant for finding out the profits or the surplus generated by the business. So in this way it is related. So the objective of accounting ultimately is to find out or ascertain the need appreciation in the asset value of appreciation in the need value of the assets, and that is nothing but the generation of surplus. And if the surplus if the organization does not perform properly, then it will face deficiency, that is loss. So profit or loss, the statement of profit or loss, and that is originally the account which we intend to prepare. And so through profit or loss account, what do? We close all the revenue items. I told you the expenses and losses are neutralized. They are closed down. I have told you, just we have purchased goods for cash or credit. Okay, purchase account debit to cash, purchase account debit to and the creditors. Say it is 20,000 and it is 40,000. So total purchase is 60,000. Now, at the flag end of the year, what do? We record the purchase over here in the trading account to purchase. And if from this, if you develop the journal entry, what you will get the journal entry trading account debit to purchase. Okay, to purchase. The purchase was debited, now purchase is being credited. So purchase is neutralized. Purchase is a revenue account and it has been neutralized. Okay, it is nothing but closing the revenue item. Clear? So trial balance gives us the total picture of all the revenue items. Clear? It is as it is the expenses and incomes, it is the losses and the gains, and the concept is matching cost against revenue. Clear? So after preparation of the profit and loss account or statement of profit, there remains in the balance sheet some items like capital reserve, like general reserve, like syndicators, bill receivable, bank overdraft, some assets like land and building, plant and machinery, furniture, feature, sundry debtors, bill receivable, cash, bank. All these are not closed. All these are not closed. So trial balance, from the trial balance, say it is our trial balance, and from trial balance the expenses, incomes, losses, gains, all these are written off. Okay, all the accounts are closed down. That is to the passing of closing entry. That means we transfer all the revenue items to trading and profit and loss account. Now some accounts are left, those which have not yet been considered. Okay, which have not yet been considered. What are the items? I have told you some asset item, land and building, plant and machinery, goodwill, furniture, fixture, sundry debtors, bill receivable, bank balance, cash balance, prepaid expenses, like this. This is one part. It is in the debit side of the trial balance, and in the credit side of the trial balance, capital, okay, capital, liability, syndicators, bills payable, bank overdraft, like all this. So these are the liabilities. Okay. So these, we make a statement, we prepare a statement of the balance item. Mind it, you will not get this type of definition. So in one interview, I was asked to answer by the teacher, what is balance sheet? People say balance sheet is a statement of this. So I told them in Majak in fun, balance is a statement of balance item left after the preparation of the trading and profit and loss account. Right? And we have justified it quietly. Clear? The balance item left. Trial balance is a trial balance concept contains all the items. Income, expense. It has transferred to trading account. Trading and profit and loss account. Losses, gain, it has been transferred to the profit and loss account. Now what are left? Left some assets, fixed or current, whatever it may be, some liabilities. The debit side, some item, and the credit side. In the debit side, some assets, and the credit side, some liabilities. And we make a statement, we prepare a statement with the balance item. And the balance item are either assets, not only either, but balance item are assets and some items of liability. So both are equated. Clear? Sorry, not equated. A difference is there. The total asset, the assets side, the asset side, this is the asset side. The trial balance, we have all the liabilities and all the assets. Assets are transferred to over here, and liabilities are transferred to this one. But there will be gap. And what is the gap? It is the balance of profit and loss account. That is profit. Okay, the profit will be added to capital. Profit will be added to capital. All other liability will be put, and all other assets will be written in the right side of the statement, and we will get the balance sheet. So what is balance sheet? I have told you so many things repeatedly. Right now I am making a presentation in a nutshell. So what is balance sheet? In my words, you think, you consider it in your own way. Balance sheet is a statement of items, accounting items. Okay, accounting items left after the preparation of the profit and loss account. After preparation, profit and loss account includes trading account. So after preparation of trading and profit and loss account, the items left that are considered for the preparation of balance sheet. So balance sheet, as you know, sheet is a statement of all the balance item left after the preparation of trading and profit and loss account. Clear? So this is exactly the meaning. Why it is called balance sheet? In nowhere I have gone through in my life the balance. Why it is called balance sheet? There is nothing, no statement is there why it is called balance sheet. But my just what I have realized, what I have understood, being a student of commerce and economics and accounts, I am telling you, balance sheet is a statement of items which is left after the preparation of the trading and profit and loss account. And obviously the items are assets and some liabilities. So it is a statement of assets and liability. So I can say balance sheet, and alternatively I say balance sheet is a statement of some assets and liabilities. Assets owned by the organization or liabilities owned by the organization. Okay. So this is the statement. And that is why my suggestion is, friend, it is better to say that it is not the balance sheet, it should be considered as the statement of affairs. What type of affairs? Personal affairs? No. Personal affairs is something, a statement of financial affairs. Financial affairs are of two types, what I have told you. There is an affair wherefrom I can get, I can claim the service, I have the right to get the service, and the financial relation may be negative, where someone may claim service from us. The claim to service is asset, and right to service is asset, and claim to service is liability. Any claim, outside claim on me, on the business entity is my liability, and any right which I enjoy on the other part, on the outsiders, is my asset. Okay, it is the asset of the entity. So it is a statement of affairs. Affair positive, affair negative. What type of affair? Not the personal, but an economic affair, financial affair. So it is a statement of financial position. It is a statement of financial position. Clear? So this is the total view. And what does it contain? The balance sheet or a statement of affairs, whatever you call, it contains some assets in one side, some liabilities at the other side. Clear? So now I am giving you some ideas over here. A balance sheet is a financial statement. What I have told you, I have told you everything, but I want to go through what I have written over here. A balance sheet is a financial statement that reports on an organization's assets, liabilities, and owner's equity. I am coming to that part, owner's equity. Owner's equity I have already discussed, but right now again I will let you know. At a specific point of time, mind it. Now, say you consider a case, say this is our balance sheet at a particular date. Here the cash balance is being found 5,000, and the bank is how much? 15,000. Here, just you think. Now, just after 10 p.m. 11 a.m. I go to the banker and withdraw 10,000. Then what will happen? The bank balance will go down. Here, bank balance will go down to 15,000, and the cash balance will go up to 15,000. Okay. Now bank balance will reduce by 10,000, so it will be 5,000, and cash balance will be 15,000, which is before 11. Exactly at 11 it is the figure, but exactly after at 11 and 11 a.m. it is the figure, and 11:1 a.m. it is changing. So balance sheet, the asset liability position changes. Again thinking, I have this indicator of rupees 30,000, and I have a bank balance of 15,000. Now I am making a payment by check. What is happening? Bank account is credited and Sunday creditors debited. Okay. Now the Sunday creditors balance changes and bank balance also changes. So it is, what is that? It is at a particular point of time, as a specific point of time. Clear? At a particular point of time. That is why we call the balance sheet is a snapshot of the financial position of the organization. Snapshot, you know, a train is running, the horse is running, someone is going and here and there, and you are taking a photograph. Okay? You are taking a photograph. What is that? It is a snapshot. Clear? I think I have cleared all these things. So balance sheet is nothing. It is a snapshot. on the financial state at a particular point of time. Clear? It is a snapshot. Understood? So why snapshot? I have already told you. I have some assets and liability position right now at 10:30. Say. Now I am making a payment to my Sunday creditors through check, and the amount is he encashed the check. Okay, he encashed the check, and what is the result? My bank balance reduces, and also syndicatus reduces. But again, you think I have made a purchase. I have made sales of something in cash. Okay, so what is that? Sales account, credit, and debtors account debit. So debtor is enhancing. So all time, the asset. A business house is what? A business house is for earning something with the help of the utilization of the assets. The assets are rotating. They are circulating. As they are circulating, you are getting thousands of financial position. Okay. And a particular position at a particular time, whenever you are taking the snapshot, you are getting the position at a particular point of time. That is why we write balance sheet as at. In case of trading and profit and loss account, what we write? We write trading and profit and loss account for the year ended. Okay, that is all the transactions effected during the period of 1 year. Okay, that is we are considering all the accounts are being considered which have been developed during a particular accounting period of 1 month or 3 months or 6 months or 1 year. But balance sheet is a snapshot. It is at a particular point of time. Okay. And then,
Sir, may I come in?
so it provides a basis for now. Why do that? But we basically try to understand what is our development as a result of application of the assets. I have utilized different assets and what is my return. So we try to compute the return on our assets deployed. Okay. So now I have written over here, it is a statement of financial position. It shows what an accounting entity owes and what owns and what it owes at a specific point of time, and it displays this. It displays this information in terms of the assets and liabilities and equity. What is now come to the point equity? What is equity? Equity is the right to asset, right to assets, right to the net assets, right of whom? Of the owners. The owners have invested amount. Clear? The owners have invested amount. I have invested rupees. Just think it. Consider it. Here the owner's capital, owner's equity, the capital. Capital is 1 lakh. Okay. And now there are other balances of rupees 90,000, the total. But this now there are different types of assets and there are different types of liabilities. So think it. An organization has a total assets. Fixed assets 1 lakh, current assets 50,000. Okay. Then what is the total asset? Total assets 1,50,000. Clear? Now the company, the organization has a liability of rupees 80,000 outside this liability. Clear? Now from this 1,50,000 you deduct 80,000 and the 70,000 is in your hand. That is the right of the owner. Okay, and that is known as owner's equity. So owner's equity is regarded as the total assets minus outsiders liability. Clear? So owner's equity or equity refers to the right of the owner to the need. We have done trading account, we have done profit and loss account, we have prepared balance sheet, all these things. When we have prepared trading account, we have prepared trading account after summarizing all the accounts. What are the accounts? Some accounts are, some are debit balances, some are credit balances. And the debit balances, the credit balances are shown in a statement, and that is known as trial balance. Trial balance is a summarized form of all the ledger accounts. Ledger accounts, how you have generated? I have generated the ledger accounts as a result of meeting the different transactions during the period. Okay, and I have prepared the trial balance at a particular date. The trial balance concept contains expense, losses, incomes, gains, syndicatus, and some other. Okay, and some assets and some liabilities. With the help of all income, expenses, losses, gains, we prepare a statement, and that is the statement of profit or loss account, or profit and loss account, or a statement of profit or loss. And it is nothing, it is based on the matching cost against revenue. What revenue I have generated, and from that revenue I have deducted all the expenses incurred to generate that income. Are you getting me? Right? So it's income, that is revenue, minus all the expenses met to generate that revenue. So that is the matching cost against revenue, and thereby I get profit. And that profit is nothing but the addition to our neat assets. Addition to our neat assets, okay? It is added to the capital. Clear? Now, the remaining balance are what? Organization starts with some assets, land, building, plant, machinery, furniture, furniture, and some other assets emanated during the period. These are known as current assets like radiators, bill receivable, bank balance, cash balance, prepaid expenses, and like all this. Okay? So these are our assets also. These are known as current assets. So total fixed assets and current assets, the total assets, and there are other liabilities, current liabilities, indicators, bill payable, bank overdraft, and some other outside liabilities, bank loan and like. So from the total assets, if we deduct the outside liabilities, we get the net worth of the owners. Okay, that is equity. And that equity, net worth of the owner, that is right of the owners to the business house, to the neat assets, is the equity of the owner. And that equity is the liability of the organization, because that amount must be paid out to the owner. Clear? So it is put in the liability side. And that is why the total asset side must be equated to the liability side. Clear? And this is known as balance sheet. Why it is called balance sheet? Balance sheet, it is regarded as the balance sheet because it is the statement of all the items which left, which left unused after the preparation of trading and profit and loss account. So it is the statement of balance item. Balance item refers to what? All the items other than expense, income, loss, gain. Clear? And that is their either asset or liabilities. So it is a statement of assets and liabilities. Which are assets? What are assets? Asset is my right to service. So wherefrom I can enjoy the right, that is asset. And liability is a claim to service. When someone claims something from me and I have to meet that, that is my liability. So is this the total liability must be equal to the total assets. And with the help of all these items, we prepare the statement, and that is balance sheet. So balance sheet is the statement which is prepared with the remaining item after preparation of the remaining item in the trial balance left after the preparation of the trading and profit and loss account. And we make some necessary adjustment, as I have told you, as because these are some transactions have already effected, but they are not recorded. Okay, well, impact is there, but no exact flow of money is there, and that is we make some necessary adjustment, as in case of outstanding expenses, prepaid expenses, okay, unexpired expenses, and some depreciation, okay, like anything used as a sample, and like all this. Clear? So all these are taken into account when we prepare the balance sheet, and this balance sheet should be treated as the statement of affairs. Affairs means whatever, no personal affair, it is the financial affair, that is the affair of the organization in terms of money, and the affair wherefrom which is positively related to me, but the affair which basically delight, the affairs which delight me, which give me pleasure, that is my positive affair, that is my asset, and the affair which basically gives me pain, the affairs, financial affair that extend pain to me, pain, P-I-N, pain. Oh, that is where I have to meet the services. Okay, any claim that would be emanated in the days coming for any future past events or present event, and that is known as my liability. Okay, so it is better to say that instead of balance sheet, we should say it is a statement of affairs. Clear? So that is all these things what I have already told you. Now I have also told you the equity, owner's equity. Equity is the right. Equity is the right. Basically, all the items, all the liabilities are the equity. In fact, why? Because the persons who have given amount to you, the syndicators have sold goods to you. Sorry, you have purchased goods from them. Yes, they have sold goods to me on credit. So they have the right they have the right to claim that amount. So this is all the liability side is nothing but the equity. So there are two types of equity. The equity means right. Equity means right. One, equity of the outsiders. Outsiders equity means the claim I have to meet, and owner's equity, insider's equity means the equity to the owner. Okay. So equity is the right to the need. Equity is the right to the assets of the organization. That is the genuine definition of equity. So equity is the right to the assets of the organization. When the right is of the outsiders, it is known as outsiders equity. When the right is of the insider, that is owner, it is known as owner's equity. And how to get the owner's equity? Total assets minus outsiders equity will be equal to insiders, that is owner's equity. Clear? So in a nutshell, in detail, I would like to say, I have told you all these things. Because this is not the high time for you to know all these things, but I would like to say this is the high time to know all these things for your future, for having your base duly cleared. We did not go through in the inaugural stages of accounting all these words. We got it after 2 or 3 or 4 years, but right now your syllabus is such, the knowledge, the flow of knowledge is such, you have to know all these things, and that is why I have cleared all the related issues. Okay.